Hi, welcome to Let's Talk Bonds, the weekly bond podcast from INR Bonds. I'm Arjun Patsati. And in this podcast, we talk about how rupees 5 trillion or rupees 5 lakh crores of bonds issued to investors by the government is causing deep losses. With today's 10-year bond, the latest bond that was issued by the government, where the coupon rate was 7.26%. Before that, if you're a financial advisor and you want your clients to save better through bonds, the best place for you is INR Bonds Partners, where we should give you all the tools necessary for you to identify the correct bond and show it to your clients which fits into their portfolios, and also help you in a easy investment process for your clients through all the tools available through our partner portal. So log into inrbonds.com and just sign in to our partners, and we will contact you and take you through the portal and help you and your clients in terms of best product bonds available for their investments, and they save better, and you can gain more clients as well as increase your fixed income AUM.
As a financial advisor, my biggest responsibility is to help my clients make the right investment choices. Now, with INR bonds, buying and investing in bonds for my clients is quick and easy. With my guidance on bonds, my clients are happy and I'm getting new business every day. Register as a financial advisor on inrbonds.com to help your clients invest and save better through bonds.
The government issued a new 10-year bond at 7.26% today. But in the last 2 years, the government had issued the same 10-year bond, that is 10 years there, when it was 10 years, at levels of 5.77%, 5.79%, 5.85%, then 6.1%, and 6.54%. And there were more around 5 lakh crores, rupees 5 lakh crores of issuances of these bonds. And investors who have bought that are now finding that the prices are down very sharply because the yields have gone up, and the new coupon is at 7.26%. So those who have invested in those bonds are actually earning 1.5% less, and with inflation running so high, they're actually earning negative carry on inflation. And this was because the RBI was protecting the yield on the government bond, and ultimately the investors are suffering. Hence, it's very important for investors to understand the impact of these issuances, and they should, especially the retail investors, be very careful when they are investing in longer maturity bonds, because the pricing can be screwed because of various factors which is done by the government and the central bank, which they at that point of time could be as part of that policy, but the repercussions are very severe down the line. Back to what are the fixed income options available for investors. The GSEC yields have come down around the same levels, between 1 to 3 year in a range of 6.20 to 7%, 5 year closer to 7%, and that 10 year at 7.26%, the latest, 15 and 30 year at 7.4 and 7.6%. State development loans around 7.65%. Bharat bond ETFs in the 10 year is at closer to 7.5%. 3 year is below 7%, just marginally below 7%. In the corporate bond space, again, 2 to 3 year bond. 2 year bonds are below 7% for AAA bonds. 3 years in a range of 7.15 to 7.5. Could be higher as we go down the rating scale. And 10-year bonds in a various ranges, but around 795 to 780, 85 to 8 quarter for very highly rated bonds. And if you go down the rating scale, again, higher than that. So the options available are very clear for investors. And so if you have, take, for example, Shriram Transport is issuing 10-year bond at 8.76%. While Tata Capital, LIC Housing Finance are all issuing bonds, 10-year bonds at below. Tata Capital is a 10-year and LIC issuing 10-year bonds at below 8%. Capital Housing Finance around 8.15%. You had others like HDB, LIC Housing, Aditya Birla, and SIDBI and others issuing 3-year bonds. These are all in the range of around 7.4 to 7.8%, 7.7, 7.8%, and some MLDs from Edelweiss. Citicorp issued 2-year bonds at 7% levels. Yeah. So that's where retail private placements are in this market. And in all this, the best options for investors, again, we stress, are in the shorter maturity between 1 to 3 years, where that yields are enough, attractive enough, and also that money comes back quickly. And because we're not sure how the inflation can pan out. And long-term bonds are best not at this point of time, unless investors understand the risk of long-term bonds, best to be avoided. Thank you very much for listening in. To follow us on all podcast channels, and do not forget to download our app Quick Invest by INR Bonds for the best curated list of bonds, most information, transparency, and the easiest of in-app investment process. Thank you very much.